Want to hear about some lucrative tax strategies you can use to lower your tax bill? Well, keep listening as we discuss different deductions for you to consider. Hello, and welcome to the Wealth Minded MD podcast with your money best friends. I'm Dr. Alicia Taylor.
And I'm Dr. Brittany Halford.
And of course, we're here to help you build wealth and make good money decisions so you can create the life you desire with more control over your time. If you've been looking for a financial planner who truly gets you, let me tell you about Bona Finance. Ben and his team at Bona Finance are like the primary care physicians for your finances. They take the time to understand your goals, meet with you regularly for financial checkups, and build real trust and rapport so your plan grows and adapts as your life changes.
What really sets Ben apart is his expertise. He understands student loans for high-income earners, something most planners overlook. And he's a tax strategist, helping you invest your money in the most tax-efficient way possible. And the best part, Bona Finance operates on a flat fee model. So you always know exactly what you're paying. No commissions, no hidden costs, just honest financial guidance.
Ben's approach isn't just about making your money grow, it's about making sure your wealth aligns with your life. So if you're looking for someone who can manage your investments, grow your wealth, file your taxes, and help you with your student loans, there's only one choice: Bona Finance.
Book a consultation at bonafidefinance.com/wealthmindedmd or email hello@bonafidefinance.com and tell them we sent you. All right, Alicia, what's going on in Atlanta? How is the weather there?
Girl, it's about to be a winter storm. I am looking in my fridge like, do I have perishable and non-perishable items? Do I have bottled water? Do I have a full tank of gas? I am in crisis mode trying to figure out, do I have enough stuff? And the city is also in crisis mode. The Publix, I think there was like one loaf of bread left. The toilet paper's gone. You know, that's one of the first things to go. We're in Atlanta. We're in the South. For someone like you would probably laugh at this little dusting we might get. But the city of Atlanta is not prepared for this. We don't have the infrastructure. We just lose our minds. It's not a good scene. So I'm a little bummed that this is happening during the weekend and not during the weekday. I was hoping that this would,
You sound like the kids.
give me a few days off from work, but unfortunately, it's just gonna ruin my weekend. We'll see what's going on. I had plans this weekend. I guess this is not gonna happen. I don't know. So I'm getting ready for a snowstorm. And also, before I knew about this snowstorm, I was gonna prep for my aunt's 70th birthday. I have a lot of aunts. I think I mentioned this multiple times. My dad has 7 siblings. My mom has 13. Got a lot of aunts. And one of them's turning 70. So we had planned to rent out part of the restaurant and have a bunch of people there, have this big gathering and celebratory thing. And now I don't know if that's going to happen. Are we going to postpone it? So getting ready for a snowstorm and also preparing for, hopefully, if there's not as much snow, that I can celebrate my aunt's birthday.
Oh, that's beautiful. I love when you bring family together. And similarly, we are also preparing for a snowstorm. It's occurring on the weekend. I still have to work, but I'm grateful that it's happening on the weekend because when it happens on a weekday, that means that the kids are out of school. That means I got to figure things out for myself. I have no child care. It's entertainment with mommy.
You're so funny. This is different lives. I see that now.
Oh my. But it will potentially cancel a play date that Brooke has and was really excited about. Of course, she could always reschedule. It's like a small play date with 3 kids. The moms are texting back and forth. Oh, should we cancel preemptively? Should we just wait? Is the place going to be open? What's the cancellation policy? So I understand how the weather can really distort things and disrupt our plans. And I lived in Atlanta for 2 years, and I remember these days when there was a threat of snow. And then it would be like one little snowflake falling from the sky. And I'm like, y'all did all this for one little snowflake.
Yes, essentially is the answer.
All right. Well, I hope that you and your family stay safe. And if you're going to be locked in, find somebody to be locked in with, girl. Enjoy the time. So, all right. Well, Alicia, last week, you and Ben, you had quite the conversation. And I loved a lot of what he mentioned about the risk of potentially making a mistake with your taxes versus the value and the peace of mind that someone can afford. And honestly, I can say personally that our tax situation, having the wrong tax accountant, has disrupted my life, caused conflict within the marriage, gave additional angst, anxiety, and stress that was unnecessary. So I see tremendous value in having a tax accountant and one that is willing to meet with you to really understand your goals, to guide you, that can talk to the IRS. Ben talked about how long he waits on the phone for the IRS to pick up and can speak to them on your behalf. Like all of that is good. It's like icing on the cake. So you don't always get that with someone who can file your taxes, let alone help you to plan. And in part two, we're going to talk a little bit more, or you all going to talk about, I listened, about tax strategy. And this is where it's like, oh, I love this conversation. Let me see what Ben has to say about tax strategy, because it really changes the game for high income professionals, especially if you have some type of 1099 income.
I agree with you. In fact, after Ben and I had this conversation, he was emailing me about one of the cases of one of his clients who used tax software. I think it was like TurboTax or H&R Block or something like that, but actually inputted the information in wrong and ended up paying over $20,000 more in taxes than he needed to. Thankfully,
Wow.
Ben was able to fix the issue, amend the tax return, get them their money. But it's some of those kinds of situations that are like, okay, not only is the tax strategy helpful, but just having somebody, as you mentioned, who can speak to the IRS, who can look things over and let you know, give you peace of mind that yes, things are filed correctly. And more importantly, prevent you from paying more than you got to pay. So we are all about, saving money on taxes and making sure that things are filed properly. I, like you, am really excited because this part of the conversation is when we get into the different tax strategies. And so I think folks will really find this helpful. I know, as I mentioned last week, Ben and his team are still accepting tax clients, but you have to contact him before the end of the month. Again, once it gets March and April, he is focused on the tax clients he already has and making sure that their stuff is filed on time. And so if you are somebody who wants to elicit Ben and his team to help you with your tax filing and tax strategy throughout the year, please be sure to reach out to Ben at Bonafide Finance before the end of February. You can email him today at hello@bonafidefinance.com. All right, let's listen to part 2 of this interview. All right, let's transition a little bit to some tax strategy. People are listening to this and they're thinking, ooh, I wonder what Ben's got up his sleeve. I wonder if there's something that I haven't heard of that I need to take advantage of and those sort of things. So I want to ask you first, what do you think are some of the most commonly overlooked tax incentives or deductions for high income professionals?
Well, I mean, two of the best incentives in the code, and these aren't always applicable for the high income earner, and then I'll pivot into what I do think is more relevant. But if you're just like, wow, what's a juicy example of something where I could make a lot of money or save a lot of money in taxes? One is the Section 121 exclusion on your home. So if you live in your home, own it, and use it for more than 2 years, you can have up to $500,000 of capital gains on your primary residence. $500,000 capital gains is basically all the money that you made on it, and you can sell it and then not have to pay any taxes on that $500,000. And so conceivably, you could do this year after year after year. $500,000 of tax-free gains for a high-income earner. We're talking about 24% of that getting lost otherwise to taxes. And that's just at the federal level, not including maybe what would be subject to the state level. Potentially, it's getting to be as much as 30 to 35%. As simple and mundane as it is, we're just talking about your primary residence, like that's a pretty big benefit. Now, the drawback to really make that work is usually to get the $500,000 in capital gains, you got to do some renovations on the property, and then you're only living in it for 2 years, and then maybe you're relocating. And so this is all to my point a moment ago, Alicia. Like, yes, that's a really nice incentive. It comes with strings attached to it. And so is that something that you want to do, or do you need to do, or is that something that excites you? The other, probably the biggest benefit that I know in the tax code, and again, it doesn't really apply to a lot, but just to throw it out there in case someone's looking for a really juicy example, is the qualified small business stock option, also known as the KSBO. I think it's a Section 1201 break. So if you are structured as a C Corp, and quite frankly, I don't know if this directly applies to professional service corporations, I'd have to double check it. But if you are set up as a C Corp and have limited number of shareholders and ultimately have less than 50 million, I think, in annual gross revenue, which is what's kind of needed to be qualified as a small business, the tax perk to this is that you could potentially sell that entity, if you can find someone who wants to buy it, for as much as 10 million in gains specific to your ownership level and have all of that be tax-free income to you. Not necessarily if it's something that's particularly relevant, but boy, I tell you what, for the person in which it is, which I've come across one instance in which this did apply to somebody, yowzers, that's a couple $1 million in tax savings. Just as an illustration, like sometimes the really potent tax savings are something that's like, well, if it applies, it's absolutely wonderful. The thing is, it's kind of hard to get it to apply to you, or you have to kind of really drive yourself towards that end goal. But more commonly, like the stuff that we most commonly have clients taking advantage of, especially if they're a W-2 wage earner. So let's just kind of break this out between W-2 wage earner versus somebody who's self-employed is, what kind of money can we be putting away in your 401k, or maybe in a 403b or in a 457b? In a 401k, 403b would only get aggregated together, but a 457 is considered distinct and only something that you can contribute to separately. But just between those two accounts, you maybe can be putting away $46,000 a year individually. And then if you're a dual physician household, which sometimes we see, and they also have that, we can put another $46,000 a year away. And so some of this is like, well, how much money do you want to be saving for the future and your long-term needs? These are all retirement account related, but maybe that's as much as you need to be saving for your future. And there you go. That's as much tax strategies that's available to you, but it's also as much as what you perhaps need to pursue to hit some of your goals. Solo 401k, which has been made mention of. The cash balance pension plan is another one that has been made mention of. You've made mention too, Leisha, potentially hiring your kids out. These are considerations that we've had just to chat about that a little bit, or the Augusta Rule. All of these are like, well, do you want to do the extra legwork associated with them? Again, there are no free tax benefits, but if you are willing to do it, or if we can get it to all make business sense and it makes sense within the broader picture of your finances, then by all means, let's pursue this. So like, you can only hire children out in your business and potentially sidestep. Now I say potentially because there are various qualifications that have to be made, but potentially sidestep all payroll taxes, FICA and Medicare taxes, and then all state, federal, and state income taxes. So you can get a full tax deduction. You paid your kids' wages, just like you would pay for any employee. So that's a write-off for you as a business owner. And then all that money comes home to them and they don't have to pay any taxes on it. And then if we only put that money into a Roth IRA account, that money can grow tax-free for the remainder of their life. So it really doesn't get much better than that. The issue is you have to be a small business owner who's got enough compensation in which you want to hire your kids. Your kids have to be of an age or a capacity in which they can work for you in a way that we can say, hey, this is legitimate work that they're doing. Potentially they could be as small as infants. The reality is like, well, how am I going to hire my 5-year-old what to do for me? And there are things that we can do, but it still has to pass the smell test, as I like to say. We can't just simply hire them out, pay them a ridiculous sum of money and just say, yeah, they work for me. No, the IRS, quite frankly, won't allow that. I mean, at least if they were to audit you, they disallow it. So we have to still jump through all the hoops to make this work. But the Augusta Rule, other great example of this if you're a small business owner. And I love this. It's something that we personally use, encourage all my clients to use it. But again, you got to be willing to do this. And sometimes it's a matter of adjusting your business policies or practices to make it work. But let's say you have a large company event or you invite clients to your home. If you feel comfortable with doing such a thing, you can rent out a portion of your house to host that event. It has to be based on fair market value of what you would be seeing other similar venues renting for. You can issue basically that rental income from the business to you personally. It does require a 1099 miscellaneous statement, should ideally be reported on the Schedule 1, both as income and then as a deduction, referencing the Section 280 Cap A, I believe, reference of the code, in which anybody, not just a business owner, but anybody, what we're trying to take advantage of is that you, as an individual, you don't even have to be a business owner, honestly. You could just do this directly. This is one of the neater tax benefits in the code. You can rent your house out for up to 14 days, almost really at any dollar amount. It doesn't have to be based on fair market value, but could be potentially tens of thousands of dollars. None of that compensation income to you is taxable. You don't even actually have to technically report it on the tax return. It's not required. It doesn't even show up on the Schedule E, the rental property. You just pocket it and it's permitted. And so they call it the Augusta Rule. Perhaps you've already brought this up, Alicia, but it's called the Augusta Rule because it's based off of folks who are doing this very thing in Augusta, Georgia with the Masters tournament where people are willing to pay large sums of money. Maybe you go on a vacation, coordinate that and time it up with a large sporting event, which other people might be interested in your house. You put it on Airbnb. And again, you can just do this without having a business, but where it's kind of interesting is as a business, you can have the business rent it out. And as long as it fits what's called an arm's length transaction, it's legitimate. And so that's something that we've done. What I would just want to communicate and convey, folks, is like, I've suggested this to clients. They're like, oh, but wait a second, I have to have someone at my house. I don't really want anybody to come to my house. I don't even know where I live. And so it's like, yeah, this is a really cool idea. Or maybe, yeah, you love the idea of the Airbnb and like you just rent it out, not even business wise. It's just to some stranger. And they're like, nah, full stop. Like that's a tax benefit, but I'm not renting my house out to somebody while I'm on vacation. It's not going to happen. And so part of our work is to suggest it to you, talk about the nuances, talk about what it takes to do these sort of things, but then also just to see if you even need to do it. And I would just say, Leisha, so much of our work is giving people permission to pass on an opportunity and just say, you know what? I don't need to do that. I'm fine. And if that only means I'm missing out on a tax opportunity, that's okay. I'm cool with that. Thanks for letting me know about it, but I don't see us ever pursuing that. And then they can just be like, yeah, you know what? I'm functioning as an informed participant in our system. I was aware and I thought it wasn't the right fit for me. And so I'm not trying to get people to do these things because sometimes I don't know if I'd even want them to do it either. It just gets to be a lot of rigmarole for everybody involved. I mean, if you want to do it, sure, we'll support you in it, but maybe actually the best outcome here is for you to just pass on it. It's neat that it's there, but it's just not something you're willing to do.
You said a lot there, and I kind of want to emphasize on a lot of the different tax strategies and things that you were talking about. But before I do, I just want to emphasize, I think for a lot of people listening, that's what they're looking for from their tax professional, is just to be informed about these things. Some people feel that they are paying for services from a tax professional, and they're like, okay, but I could rent out my home, and I didn't know that that was possible, and you didn't tell me. Or you told me about it, but you didn't tell tell me, hey, if I do it, I could save $10,000. And if I don't do it, I'm not going to save $10,000 because now my decision is different. Hey, you know what? I am a locum stock and I have a teenager. Maybe I can hire them to do some marketing for me and to set up my website. And maybe I can justify paying them just enough to max out their Roth IRA. And now I don't have to pay taxes on the money that I quote unquote paid them. And they don't have to pay taxes on the money that they received. And now this has set up my kids to retire multimillionaire before they even hit the age of 20. And so some people, they're like, when you phrase it like that, I want to take advantage of it. I want to know that I have somebody, that I've hired somebody who can at least tell me about these things and help me understand how much I might save by doing some of these things. And I think that's one of the things that I really like about you and your company is that you do that. You tell them, and then you give them permission to say, yeah, you could hire your kid, but if you don't want to, that's also okay. Yes, you could rent out your home to your business, but if you don't want people at your house, that's fine too. And so a part of this, I think, is people are probably looking for someone to actually make them aware of these different things. We're doctors or high income earners. We're busy. We've got families. We don't have time to keep up with these things. And so we want to make sure that we are hiring somebody who is keeping up with them and is willing to inform us. One of the things that I think would be really cool is for us to kind of break down some of these tax strategies that you mentioned, because some people, their ears perked up when you said some of these things. And one of the things that I like to do, my family always, laughs at me is they say, Leisha, you never take no for an answer. You get really creative. That is me when it comes to finances and money. And one of the first loopholes that you mentioned was, I think you said it was the small business stock option. All right.
Qualified small business stock option. There you go. Qualified. Yeah.
Qualified small business stock option. I have a question for you. Let's say we've got a doc who has a bunch of land that is very valuable that they are planning to sell. Could someone theoretically have a small business and then sell parts of that land in stock options so that qualifies? Like, I'm trying to figure out how they could turn, I don't know that many doctors that have stock related to their small businesses. I hear that more in the realm of people who work for like these different tech companies like Google or whatever. Maybe they get some of their payment in the form of stock option. I don't know as many medical practices that are divvying up shares of the business in stocks, but maybe they do. But I'm just trying to figure out how could somebody who maybe doesn't yet have a corporation form a corporation so that they could take advantage of this, so that they could, sell some land for a large amount or sell their medical practice. Maybe they're nearing retirement and they're thinking about selling their medical practice or buying a medical practice from somebody else. So just curious as to how somebody could maybe take advantage of what seems like a very large loophole.
Well, Leisha, I think we might have to necessarily table that as a separate conversation because this is a nuanced arrangement and I'm admittedly not up to speed on all the details and I wouldn't want to speak out of turn and give bad guidance or direction here. I did write an article for what it's worth to this. I believe it was to CNBC. It was a number of years ago. I gave some highlights because the 121 exclusion, as I may mention, and it's a section 1201 or 1202 related to qualified small business stock option are some of the best tax perks in the code. And it's just so true of so many things in tax. It's nuanced. And so what I can speak of briefly off the top of my head is that no, could you turn around and try to turn your land into stock and then sell it? I don't see any way that's going to happen. What this is related to, and it tends to be more in like a space where someone is birthing into life a new business or company. A professional services corporation couldn't count, although I don't remember that detail. But what would be more common and what I'm more certain about would be, let's think of a small tech company. Maybe it's a medical supplies or a medical technology company that you're putting together. As original business owner buying into, you could either set it up as where you're the sole shareholder, or maybe usually you need multiple shareholders because you need to raise the capital to be able to get this thing up and running and going. But we basically take this from scratch as nothing and turn it into something that's running multi-million dollars of sales, and we're able to get it to where someone else is willing to now buy it from us. In that sort of scope, yes, you could sell that and have as much as $10 million in gains and have that all be tax-free. And depending, that's at the federal level. Now, some states also recognize the similar thing. They'll follow the federal code on this. Other states don't, but it's possible to have it both at the federal and the state level, all tax-free income. I have seen this firsthand with one individual because this is such a nuanced thing. And this is true just if we're really talking about something that's potentially going to save hundreds of thousands, millions of dollars in taxes, your direct tax preparer is probably not the person. Maybe they actually prepare the return and handle this, but the person signing off on this, I almost guarantee you couldn't or shouldn't be your person who's doing the tax return. There's like a scope in the accounting profession of skill sets. And so at the minimum level, you have like an accounting bookkeeper, don't really know a whole lot about tax ramifications for transactions, but they help to keep everything organized and orderly. Then you have more of a tax level preparer who's familiar with tax matters, much like myself, either as an enrolled agent or a CPA, can handle the tax return and is up to speed maybe on revenue procedures or technical asset memos, just the tax code and what's given in instructions. But the next tier, and this isn't something that you would readily see, but quite frankly, it could be your best tax strategist, would be what's known as a tax attorney. This is the person who is presumably deeply in the weeds of the actual tax code, tax law, because all these tax matters are fundamentally driven by tax law. The highest authority on this, interesting enough, Disha, is not the IRS, it's the tax courts. And there are times where there's a disconnect between what the IRS determines, which kind of functions as a steward or an administrator, what they've only said versus what only the tax courts have to say. And so when we're taking really significant tax savings, like the qualified small business stock option, you need to be working within a tax attorney or a specialized firm that's basically going to go through all this in fine detail, like you would expect an attorney to do, to make sure that we have done everything to make this on the up and up. And the IRS, or more so the tax courts, don't have anything to take against this. And you have to do that. Like for something that large, there's no chance I would take that on. Like I would be the wrong person. I maybe would prepare the return, but we would definitely be working with a third party, rubber stamping this and saying it's good to go. And I would just want to maybe convey that to folks. It's like there's a spectrum of tax professionals that you're working with. Realistically, a tax attorney is going to charge a lot more, even at the personal level. They're more focused in corporate matters, but you might pay as much as $3,000 an hour for their time at the very high end. So it's like, well, perhaps they're the best person to speak with, but is there any tax savings to be had that you're willing to pay $3,000 an hour for? There's kind of a scale that people fall into here. At least in my experience with high income earners, working with an attorney, especially at those sort of billable hours, isn't worthwhile. Not for either the attorney or for you. It just doesn't make sense. And so trying to match you up with the right person, given the scope of what's going on, is, all part of what's taking place as well. But hopefully I've answered your question, Leisha, well enough. I am wanting to punt it a little because it is a nuanced conversation. But if someone's looking to maybe set up a medical technology practice or an offering, like, yes, absolutely, you should be thinking about this qualified small business stock option.
All right. So you're like, okay, Leisha, we're getting creative here, but maybe not to that extent in terms of like being able to do all of these things. And I think your point was that at a certain level, we might need to employ the services of other tax professionals. Similar to a physician, there's not just one physician for all ailments. Sometimes you need a specialist and sometimes you need multiple specialists. And so then you've got to weigh the cost of hiring multiple specialists with the tax savings and still making sure that it is worthwhile. And so I hear what you're saying. We have talked about hiring your kid, but it's not as simple as just, okay, I've hired my kid, right? You got to make sure the documentation is in place. And again, working with someone such as yourself, who's a great tax professional and is also a financial planner, can just make sure that those documents and those things are in place. So in the event you get audited, you've made sure that you've done things by the book. We've talked about renting your home to yourself, or renting your home to your business, should I say, right? Started in Augusta. The Masters were coming to Augusta. People said, hey, I want to rent my home out during this 2-week of the Masters tournament because I can make a ton of money. The Olympics are coming to Los Angeles in 2028. We've got the World Cup this year in 2026. So some people might be actually thinking about it. Hey, the games are in Atlanta. I live in Atlanta. Maybe I want to rent out my place. Or the games are in Miami or whatever city. And so we've talked about some of those things. We've talked about some of the basic retirement accounts, 401k, 403b. One of the things that I like to utilize is something called a mega backdoor Roth. So I like to have a customized solo 401k. I wondered, usually with those things, you can't just go to Fidelity or Vanguard or some brokerage firm and set that up. You got to usually go to a separate company to set up a customized plan for you. Maybe you pay a few $100 for them to set it up. But once it's set up, it's usually smooth sailing. And it seems like another way for folks to put more money into tax advantage accounts. I know a lot of physicians actually have this ability to do so through their actual job. And so I wondered if you could maybe talk a little bit about the mega backdoor Roth and how that's different from the backdoor Roth and how somebody should know if they should do either one of those things.
Yeah, absolutely. I'd love to talk about the mega and then also talk about just compliance wise and the reporting of it, how we had chatted earlier in the call about sometimes people make mistakes where they should hire a professional out. 2 common mistakes, just to mention, it would be the backdoor Roth commonly is handled incorrectly by do-it-yourselfers and not handled correctly or supported fully by retail software. Another one, just at least make mention of it, is stock basis. If you are selling shares, and particularly if they're shares that came to you through restricted stock units, most medical physicians don't come into this. It's more commonly in the tech space, but sometimes you'll see it where a medical doctor has this as well. The cost basis on those RSUs or more so ISOs aren't always handled correctly. And that in itself can easily be well worth the value, what you pay an advisor. But yes, if we're in a situation where you're contributing to not just what's available to you within your employer, but then also you have locum tenens work and you're now participating within a solo 401k, and perhaps either because you've already taken advantage of the elective deferral with your primary employer or because you don't have enough earnings to fully max out an employer profit sharing contribution. Per plan, you can contribute potentially as much as $72,000 a year into a 401k. And you can do this not just in a solo 401k, it can also be done in an employer plan if the employer plan permits this. Again, there's a lot of discretion employers have as to what benefits are allowed to you and what aren't allowed to you. And so they have to permit this sort of additional benefit if that's available. But if you're a solo 401k, you're the employer effectively, And so you can decide to do this by which custodian or administrator you're utilizing. You can make additional contributions above and beyond the employee deferral and the employer profit sharing contribution to then max out that $72,000, provided that there are sufficient net earnings in the self-employment income. That tends to be the final limit on this to be able to make those contributions. The benefit of the Roth IRA is any money we put into there, it grows for the rest of your life tax-free. And then if it gets passed on to your kids, they'll, at least under current law, get another 10 years of tax-free growth on that money. So that's not a bad deal. Given the option of putting money in taxable brokerage account versus Roth IRA, let's get as much money as we can in these Roth accounts. The problem is the IRS under the code only allows you to put so much money into these accounts. You can't just put all of it. And so you have to do it within the contribution limits allowed to you. Why is it advantageous to get the tax deferred growth? Just in case maybe you're like, I don't want all the strings attached with it. Why don't I just put the money in the taxable brokerage account? The truth is, as you build up money in these accounts, in the early stages where we have tens of thousands, maybe hundreds of thousands of dollars, the tax mechanics of this are relatively minor. It's a few $1,000s in dividends, maybe some capital gains. You can just kind of absorb that on the tax return and take it all in stride. But as that account gets into the $1 million range, and especially when it gets into the $10 million range, now we're talking about a couple of $100,000 of dividends, maybe $1 million in dividends. I don't know. You can get to be huge. And that's not money that you're necessarily receiving. That's just money that the investments had spit off and got reinvested. And you never saw any of it per se, but you received the economic benefit of it. And now you got to pay taxes on all that money. And so the reality is those smaller account balances, you can just take in stride, no big deal. You don't even really feel it. Those larger investment sums start to produce a taxable impact that you can't just take in stride. You need to fund them in some way. And what has to happen is you got to take the money out of the investment to fund it. And now we're starting to see a reduction in investments, which means we have some tax drag, as we call it, on the portfolio, which reduces your overall return. So moving into Roth IRA accounts allows us to eliminate tax drag. And so as much money as we can put into that, we eliminate that tax drag. That's overall beneficial. You know, the movement of those contributions and then conversions produce 1099-Rs, tax documents. Just so that we're clear on this is not explicitly stated on any of these tax documents that what took place here was a backdoor Roth conversion. It just is not explicitly stated. And so if you are working with someone who's not familiar enough with this tactic, they may misread those documents. What'll happen is that they don't give you the proper basis of the non-tax, non-deductible IRA contribution, and they act as if you got a tax deduction on that contribution. And then when you convert the money, all the money is taxable. And I have seen this firsthand, unfortunately, with other tax advisors in which they have messed this up. And again, if you're a high income earner and you did a $20,000 IRA to Roth conversion and you had mostly basis in that $20,000, and now that's all being treated as $20,000 taxable income when it actually wasn't, that's like a $10,000 tax mistake. This is a relatively simple thing, but easy enough to make a mistake on. And if you do, it's costly. This is where just having someone really clued into your situation and aware of what's going on and knows how to handle it correctly easily pays for itself.
Yeah. I wanted to bring this up because I think one of the things that Brittany and I are always talking to people about is, hey, it's the time for the backdoor Roth IRA. We tell people how to do it. Bank account, traditional IRA, Roth IRA, right? And people are like, okay, I got it. But I think a big part of that is communicating that to your tax professional, because you could do all this work, quote unquote, to save money on taxes and have this tax-free growth. But if it's not filed correctly, then you didn't get any savings and you might have had to pay even more in taxes. And so a part of that is not only doing the steps yourself or having your financial advisor do those steps, but it is also making sure that you have a tax professional on board who is familiar with that and knows how to file it correctly, because I think that's really important. Same thing with cash balance plans. Some people don't use retirement plans or solo 401ks. They want to employ a cash balance plan, and now you need an actuary, and now you need to make sure you didn't contribute too much, and now you need to make sure it didn't make too much, and now you need to make sure you're within compliance of the rules. And so there are all of these different things that you have to consider. One of the things that we didn't delve into too much today was oil and gas investments and how some people are considering that. But I think there are a lot of different strategies that we've kind of talked about, whether it's hiring your kids, the Augusta Rule, the backdoor Roth IRA, the mega backdoor Roth IRA, cost segregation analysis with rental properties. One of the last things that I kind of wanted to talk about was about the short-term rental loophole and real estate professional status. I know a lot of doctors who are very interested in real estate, and they're thinking, man, is there a way that I can save even more money on my taxes? And the topic of real estate comes up. So I just wanted to get your opinion on whether or not you and your business can kind of help people navigate short-term rentals and help them figure out maybe if that is something that they might be interested in pursuing, or on the converse side, maybe they don't want to do short-term rentals, but they're doing long-term rentals and sort of considering if they or their spouse should maybe opt for real estate professional status and sort of how that might be helpful. So just wondered if you could maybe talk a little bit about the real estate side of things.
Happy to do so. A couple comments to kick things off, because again, we work mostly as financial advisors. And so commonly people ask us, like, well, is real estate a good investment? And my answer on the whole is yes, you tend to make better returns in real estate investing than what you'll see in the stock market. I would say almost unequivocally, like, that's the case. The thing is, they're not free returns. And like, just as a theme that I keep going back onto, there's extra work that you do in real estate holdings. A lot of the value that comes with this is built on this notion of market efficiency and whether or not you're able to buy a house at below fair market value or at a good deal, at a bargain. And you make a lot of your money on the initial buy and the post purchase. And so what commonly happens, and this is where we probably see the most of our work with clients, is that they had bought a house, they didn't want to let it go. Maybe they loved the loan that they had on, or maybe they had trouble selling it. And so it just kind of turns into a rental because they've moved on, relocated, or just found another house. And now they're renting it out for a period of time. And whether they really want to have real estate as an investment or not, they're just kind of doing it because that's kind of what's unfolded for them. That's one client type of a situation versus someone be like, no, I just love real estate. It's my second passion. I mean, I'm a medical doctor first, but now I'm all about doing real estate, or maybe my spouse is all about this and we're just gun ho. And so what I would encourage is that for real estate to really work for you, you need to be of this latter type. You need to be just like all in, because, you have the 100-10-3-1 rule in real estate, in which in order for this to really work, you need to be looking at 100 properties, make offers on 10, have the offers at such a price point that are favorable to you, you only get 3 of them accepted, and then you settle on one of those. When you kind of start to throw the scope of real estate investing and like, I got to be looking at 100 properties, most people are like, okay, I don't know if I'm that committed or willing to pursue this. If you are, and especially if you have a spouse who is, and it's available, you could potentially qualify for the real estate professional status. What's beneficial there primarily is if there are any losses associated with the rentals, paper losses in a particular way, you can start to write those losses off against other ordinary income. Otherwise, the losses get treated as what's called passive loss. It can only get applied to passive income. There used to be a loophole. This is like just one of those things to know. Only if a loophole is too good to be true. Look, at the end of the day, the IRS, or more so the Congress, wants and needs tax money. And so if too much money is getting bled out through a loophole, they close the loophole. That's just what happens. It was the case that there was a loophole in which people were taking paper losses on their rental properties and applying against other ordinary income, and then they were reducing their earnings. And so like, oh, that's a great tax strategy. The truth is it was a great tax strategy, and it was too great of a tax strategy because they eventually said, no, you can't do this anymore. They put the kibosh on it back in the 80s. Since then, they've said, no, there's 2 types of income, ordinary income, and there's passive income. And any rental income by default is passive income. And you can't take a passive loss, as they call it now, and apply it against ordinary income. You can only carry it forward, and then it has to get applied against other passive income sources. And so this is just something to be aware of. All these tax law strategies, like how much do you want to pursue it? And then there's also the possibility it gets ended. But the real estate professional, if you can qualify, is certainly worthwhile. What's challenging, I should say, about the real estate professional is that you either have to be basically employed in real estate or something adjacent to that. Maybe it's in construction or real estate development. Because if you are basically occupied as an employee, working for an employer, you're disqualified from the real estate professional status, which is why I've been referencing the need for the spouse. If you're a medical doctor, you cannot be a real estate professional. The code just doesn't allow it because you're employed. Again, I don't know the fine details of this, at least off the top of my head, but it would be very difficult working in the medical field ever qualifying for the real estate professional. But your spouse, on the other hand, certainly can if they have no other activities and when they meet certain hourly requirements. There's various participation rules. Don't really know those off the top of my head, but I could at least share with you. But it is possible. It just similar to most tax matters. You kind of have to jump through the hoops and make sure you're doing what you're supposed to qualify. So that would be on the real estate side. If you wanted me to chat about the real estate investment, I'll kick it back over to you, Leisha, but happy to kind of talk about depreciation and how real estate could be a good investment and potentially does outperform. But I don't know, do you have any immediate thoughts to this question on the real estate professional?
Yeah. So to your point, if you are a full-time doctor, it is going to be very hard to qualify for real estate professional status simply because one of the qualifications is that you need to work 750 hours per year in real estate. So that's 15, 16, 17 or so hours per week in real estate. And the other qualification is you can't spend more time in another profession than you do in real estate. And so even if you do spend 15, 16, 17 hours in real estate, if you spend more than that doing your work as a physician, then you wouldn't qualify. And so real estate professional status, to your point, Ben, is harder for employed physicians, especially employed physicians who are working at least 50% time to qualify for, which is oftentimes why one of the reasons why it might make sense for your spouse to kind of consider it if your spouse is a realtor, or even if your spouse is just interested in real estate, because they may be able to put in the 750 hours required and this might be their only job. And so then they wouldn't spend more time than that in another profession to disqualify them. But I think just to bring this home, the reason why this is really, really helpful is, as you mentioned, Ben, right? The income that we get from our rental properties is considered passive income, but the income income that we receive from our doctor jobs is considered active income. And so one of the things that a lot of people try to do is take a passive loss, right? So you're depreciating the rental property and trying to say, hey, I actually took a loss in my real estate business. And so I want to deduct that loss from my income as a doctor, AKA pay less money in taxes, right? If I'm making $300,000 as a doctor and I say, oh, I actually have a loss in real estate of $100,000, then they want to be able to say, hey, actually, I didn't make $300K total last year. I only made $200K because remember, I had that $100K loss from my rental property or from my real estate business. And as you mentioned, the IRS is like, hold on a second. Your real estate loss is passive loss. Your doctor income is active income. So you can't subtract one from the other. Real estate professional status is the way that you can. If you are a real estate professional, if you have reps status, real estate professional status, then you can subtract your losses from real estate from your active income as a doctor. And so if you've got a couple who's married, maybe one person is the doctor, the other person is the real estate professional, and now you're cooking. Now you're in business, right? Because one person can take the losses from the real estate and the other person can take the income from the doctor, and you can subtract those and pay substantially less in taxes. But as you mentioned, there's qualifications, right? We got to make sure that we're checking these boxes. And it can be hard for a physician who's employed to be both. Usually this is more of like we're working together as a couple sort of thing. For short-term rentals, it's different. You don't have to have those qualifications because the short-term rental business is considered the hotel business, right? And so the income is classified differently. There are different rules. And so that's why some physicians who maybe wouldn't qualify for real estate professional status, either because they can't be employed in the real estate professional or because they don't have a spouse who's interested in real estate or for whatever reason, they might consider short-term rentals because that does allow them to kind of subtract some of those losses from their short-term rentals, from their doctor income, and do it that way. And so my point is that, again, these are some things that you might not have been aware of, right? And for a lot of people listening, they're like, I just want someone to tell me this is possible. And I want someone to tell me what the rules are. And then I'll make the decision about maybe I do want to do this. Maybe I was always interested in investing in real estate and I didn't realize that if I did short-term rentals, maybe I would have more tax savings than if I just had a long-term rental. To your point, Ben, this does require a lot of work. And so at this point in my life, I'm not willing to put in this work, but at least I know it's an option for the future. Maybe I do want to cut back in medicine and build a real estate empire or a short-term rental empire. And at least I know that's an option. And so people, again, executing that correctly is one thing, but then you got to communicate that to your tax preparer and just make sure that whoever you've hired understands what you're doing and that they're filing things correctly. I know you want to talk about depreciation. I know we're running short on time, but what did you want to say about depreciation? You got my ears perked up.
Maybe it's just something that people misunderstand or don't get. In some ways, it's kind of like the thing that offsets the equity payment or the principal payment of your mortgage. So like a common thing that someone will give to us if they're giving us the details on the rental and it's maybe the first time they're working together is they'll just say, oh, this is what I paid in my mortgage payment. And then they'll want to write off the whole thing. And it's like, well, I mean, that's nice, but unfortunately, the whole mortgage payment isn't deductible because a portion of your mortgage payment minimally is going to principal. It's principal and interest, and it's only the interest that's deductible. So the principal portion, which is ultimately what's paying down your loan, is a non-deductible expense because you're getting ultimately economic benefit out of it. Your loan is actually getting lowered. So like you didn't incur a cost here per se, but the interest is a cost you incurred related to the loan. But what effectively kind of doubles up as that principal portion is this notion of depreciation. And it doesn't tie up dollar to dollar by any means, but what you are allowed is basically over time as you use this capital asset, as it's referred year after year, you can't write that expense off all at once. More or less, the IRS doesn't allow it unless we're in a special bonus depreciation arrangement, which we alluded to earlier. You can only take this in bite-sized chunks, if you will. And the bite-sized chunks varies depending on what the capital asset is. But if we're looking in a residential property, the bite-sized chunks are 27 and a half bite-sized chunks is what you get. And so depreciation is something that gets more or less applied to the principal portion of that mortgage payment. What I will say is this is another tactic of do-it-yourself software. We have commonly seen folks when they are doing things themselves not handle the depreciation at all. So one, it's just a deduction that they're not taking, but probably what's more unique, one of the things about depreciation I don't think gets enough attention. There's always things. One person described the IRS or the tax law as never ending loose ends. And I just think that's so true. Like there's always a catch or gotcha or, oh, here's this other bit associated with it, is that you potentially have what's known as depreciation recapture when you go to sell really any capital asset, but it's most directly applicable to real estate, which tends to increase in value. And so when you go to sell an asset that you've depreciated, that it's increased in value and you can sell it for more than what you paid for it, all the depreciation you took on that asset basically has to be undone through this concept of depreciation recapture. So like the interesting thing about depreciation is a tax benefit for now that interesting enough, you're obliged to take because whoever wrote this law, and it's just so funny how the law really dictates everything, but the law can be rather willy-nilly. as to what actually made it into law. And they only have to take a pretty literal interpretation on it, even if it doesn't make a whole lot of sense. And so the code specific to depreciation recapture, any depreciation was allowed or could have been allowed, it's of that nature, has to be taken back as depreciation recapture. So even if you didn't take depreciation, when you go to sell the asset, you have to pay depreciation recapture back. And so one of the things that we will do for folks, in case you happen to find yourself, you have pursued investment, real estate investing, you've been handling this yourself, and now you're just like, I'm ready to stop doing that. I'd rather pay someone to do it. Let's say you didn't take the depreciation, but you should have. Most times you have to do what's called a change in accounting method. It's by filing a form 3115. This is a complicated form. And I say this as a professional and someone who does this for a living. It's like 27 pages long, lots of detail. But the good news is if you file this form, basically allows you to take that depreciation benefit that you previously didn't have and get everything corrected. But I suppose all I have to say, Alicia, here is this is one of those things where commonly not quite handled the right way. Maybe there's no land being captured in the property where we need to allocate some amount of money towards the land as part of the purchase price, or it just isn't depreciated at all, or maybe it's depreciated too aggressively. Instead of being at 27 and a half years, they try to write it off at 15 years. Like, this is a common mistake. But I would even say this as my final comment. I like real estate. I'm a pretty handy guy. I like working on houses. I think they're fun. I just think it's enjoyable to go and check them out. But I currently, individually, personally don't have any rental properties. And the reason for that is I already have a business. I'm already very busy. I keep myself fully involved in these different activities. And I would just maybe encourage, unless you like just die hard about real estate, my direction to most clients is don't get involved with it. I think it's more complicated, more challenging, more work from what you anticipate. I have seen doctors firsthand say, actually, I don't know why I got into real estate. People can say it's a great investment. I found it to be okay. You can make more money in real estate investing, but it's not guaranteed. There is concentrated risk associated with it. The truth is, the investment that you've already made as a physician, which is the biggest investment of your life, has paid off, presuming that you're attending and now you're making that doctor money. These other investments that you're pursuing, by and large, you can pursue them if you want. Again, if you're all for it, I'm all about it. I don't want to discourage people, but you really need to just be like all in. Like, this is just something you love and you're super passionate about, because it's extra work. And, as much as you might make higher returns, it's also extra work. Do you need to do the extra work? It's very likely that your career, your job is already very demanding, takes all your time and attention, and then you don't have a lot left over for your family as it is. Why complicate your situation in order to potentially get even higher return? You don't need it. Like, you already are well situated to be in the top of various citizens within the US, just as it is, because the investment that you already pursued is paying dividends now. And so sometimes my encouragement to clients is like, let's ride that investment. That's what makes sense. Reap that benefit. If you want the complexity, so be it. But when people are kind of presented with I need to take on more complexities, like, most times they're like, yeah, I don't want that. It's hard for me to tell them to go for it when they've already got the investment that has paid off and they're winning with that.
Yeah, no, I totally hear your point. Is like, sometimes there's a balance between trying to make the most money that we can and simplicity. As you grow in your wealth, sometimes simplicity becomes a lot more valuable. And what you have to do in the wealth accumulation stage is very different than what you do in the wealth maintenance stage. And you kind of have to figure out where you are in your life. And, there's this saying, once you've won the game, stop playing. And if you've sort of won the game and you know that you're investing the amount that you need to invest each year to live the life that you want and to have the quality retirement that you want at the age that you want, then you may not need to take on extra risk or extra complexity in order to do that. One of the things I love about your firm is that for clients that are willing to take on that complexity, you're willing to support them. And for clients who are like kind of on the fence, you're willing to help them kind of consider the pros and the cons. I know we've had you here for quite a while today. Thank you so much, Ben, for all of your advice, everything from the difference between tax filing and tax strategy to everything in between. So we appreciate you. If you are listening to this and you're thinking to yourself, oh goodness, I need, a tax strategist, or I want to hire a tax professional, don't hesitate to reach out to Ben Martinek and his team at hello@bonafidefinance.com. Again, that email is hello@bonafidefinance.com. You can also get there by simply going to the website, bonafidefinance.com/wealthmindedmd. Again, he's giving discounts to our listeners, so don't forget to remind him that we sent you. So thanks so much, Ben, for everything. I'm sure our audience got something out of it. If you've got some additional questions for Ben, don't hesitate to let us know.
That sounds great. Alicia, thanks again so much for having me on the podcast. I hope everyone's really benefited from the conversation. And we provide financial planning services, but sometimes people just want to start off a tax engagement. And so some of our services initially are just tax related, maybe just a tax filing or what we call our retainer service. So where we do some tax planning with you. But as I've shared, I think on the call, where we do our best work and where I think we really bring in the most value is when we get to know you more deeply and get the full scope of everything that's going on in your finances. And then we're doing both your taxes and all the other components that are coming in. And it's a bit of a funny thing, Alicia, as I've been doing this work is that some of the ways in which we deliver the most value is just helping clients feel good with where they're at. A lot of our clients sometimes just say, Ben, I feel like you're more of a money therapist than you are anything else. And truth be told, I feel like that is, we bring the technical chops and the competency and we're here to support you. But sometimes we're just here to have you talk about, some of the challenges you're feeling with your money and having a place to go to that you can have that conversation safely and feel supported as well. And so it's a bit of not what you would expect, but honestly, in some ways, that's where we do our best work.
Awesome. Well, thanks so much for joining us.
Thanks, Alicia.
All right, now it's time for some fun money. Alicia, how are you spending your money for fun?
How am I spending my money for fun? Girl, buying things I don't need. I have these quote unquote credit card credits, and they're basically like glorified coupons. But because I don't want them to expire, go to waste, I sometimes will be like, okay, well, let me see what this store has on sale or whatever. Like I have a Lululemon credit each quarter, and I was like, oh, I like to run. I could use some more tights for the winter time or whatever, and use sports bra, that sort of thing. So I bought some stuff from Lululemon. And then there's these new jeans that are in style. Have you seen people wearing like the wide leg jeans lately?
Bell bottoms that we used to wear when we were teenagers.
So not bell bottoms. I can hear the judgment in your voice. Let's roll that back, roll it back, roll it back. There are flare jeans. That's not what I am referring to. They're just wide leg jeans, which I can see if you haven't seen them, I can see how those might sound similar. I'll have to show you a picture. But basically, there's a new style of jeans, okay? And I had this Saks Fifth Avenue credit that I needed to utilize, and Saks is going bankrupt. So I wanted to utilize it before the store was no more. So I went on the store and they had some jeans on sale. And I was like, oh, let me try these new style of jeans. If I like them, great. If I don't like them, it's not that big of a deal. I paid for it with this credit card credit that I had. But that's what I'm doing with money. Girl, buying jeans and new workout gear that I probably didn't need, but might be able to use.
I love it. I love it. As I am cleaning out my closets, I'm just like, oh, I do not need to buy anything else. So I'm going to just shop vicariously through you. Send me the picture of your jeans, girl. And then anything that you want to give away, like, oh, this is out of style. I take out of style clothing, I will take it and maybe I'll push something else out of my closet. But I love that for you. It's always nice to get a new outfit and look in the mirror and feel good about how you appear. As you're talking about being stylish, I am not being stylish, but I am embracing my inner Alicia, thinking about and spending my money on giving and generosity. So one of my cousins is getting married, and I have offered to purchase. Now we're doing artificial flowers, but to help to support the flowers for the wedding. And that's what I'm doing. I'm supporting his wedding and ensuring that they have a beautiful wedding. I did the same thing for my younger brother. And I remember Kevin's sister did the same thing for our wedding. She's like, oh, okay, I'll cover the flower bill or whatever. And so I was very grateful for that. It really helps with the budgeting when somebody offers to cover a portion of the line item on your budget. So that's what I'm doing with my fun money.
I love that. I love that. I think that's great. One of my sister-in-laws is Mexican, and she said that in her culture, that is very common, where instead of the family getting you gifts for your wedding, they each kind of take ownership of a different line item essentially on the budget. Like somebody will pay for the dress and somebody will maybe pay for the flowers or whatever. And so I love that. I mean, I've not been married, but that seems very stressful. And I've heard that flowers are very expensive. So I'm sure they're very grateful.
Yes. I think they're doing a good job of trying to keep it small and on budget. But thank you. Hopefully there aren't too many weddings. I love seeing people get married, but it's oh, these weddings are expensive. They get more expensive by the day. So, all right, people, as Leisha said, reach out to Ben. Don't be left in the dark with your taxes. Sign up for a consultation with Ben to see how he can help you to not only file your taxes, but also continue that relationship so that you can have tax planning, have his brains thinking about your taxes so that you can implement these strategies all year long and see the results of your action. And until next time, stay wealthy, people.
Hello, everybody. It's me, Brooke. I'm recording a little disclaimer for my mommy, Dr. Brittany Halford, and her friend, Dr. Lisa Taylor. Just so you know, they're not financial advisors, tax professionals, lawyers, or financial planners. Everything you hear is for education and entertainment. It's not strict financial advice, So use your best judgment, chat with a tax professional, and all those other people that you need to talk to. Thanks for tuning in today. Keep cruising on your journey to wealth and wellness. Bye-bye.